Today is Monday, April 6th, 2026. Silver is sitting at $72.13 per ounce. Gold is at $4,656.30. And if you think the story is over, if you looked at that number and thought silver already had its run, then what I'm about to show you is going to completely reframe how you're looking at this market. Because the analyst who told the world silver was going to $100 when it was sitting at $40 and was right, just came back on record. And this time his call is not $100, it is $300 to $500 per ounce this year. Not in 5 years, not as a distant ceiling. This year, as in the same calendar year we are currently sitting in, and here's what separates this from the typical bold forecast you scroll past on your feed. This man is not a permeable, throwing numbers at a wall, hoping one sticks. Michael Oliver has been analyzing market momentum for 5 decades. His framework has identified breakouts in copper, in lead, in gold before the mainstream knew what was happening. And right now, his technical readings on silver are signaling something he describes as unlike anything he has seen across his entire career. That alone is worth your next several minutes. But what I want to walk you through today goes deeper than just a price target. Because embedded inside Oliver's latest comments is a complete picture of why silver is not just moving up in price. It is undergoing a structural transformation in how the market itself is behaving. And that distinction changes everything about how you should be thinking about what is unfolding right now. So let me break this down from the beginning. $1.72. To a casual observer, that number looks impressive. Silver was trading in the 40s just months ago. It peaked at $121.79 on January 29th, a level this metal had never seen in modern market history, and then it collapsed. On January 30th alone, silver crashed to an intraday low of $74 even, a drop of nearly $40 in roughly 24 hours. Then, after recovering into the 80s and briefly touching above $94 again in late February, the war-driven sell-off dragged it all the way back to $61.20 on March 23rd, the Q1 floor. From there, it rocketed back into the low 70s. A pullback to $72 today might read like fatigue, like the momentum is broken. Michael Oliver sees the opposite. Here is what actually happened across Q1 of 2026. Silver hit a historic peak. It crashed to $74 in a single session. Recovered, got pushed back to $61.20 at the March low, and then within hours of hitting that low, days it reversed aggressively and climbed back into the 70s. That specific sequence of events is not a random price fluctuation. In Oliver's framework, it is a diagnostic signal. Markets that are in genuine structural bull phases do not behave the way casual observers expect during corrections. They do not drift lower for weeks, while participants debate whether the rally is finished. They absorb selling, touch a technical level, and then snap back with an aggression that leaves short sellers trapped and weak hands shaken out. And that is exactly what silver just did. And Oliver's point, stated plainly in his latest interview, is that the war news, the macro headlines, the volatility that has everyone nervous, none of it changed the underlying structure. The price moved, the architecture did not break. For 50 years, silver had a ceiling at $50 per ounce. Every time silver approached that level 1980, 2011 it was capped, slammed back down. It became almost mythological. This invisible barrier that silver simply could not sustain above, that ceiling is gone. Silver broke it. And according to Oliver's momentum structural analysis, when a market shatters a resistance level that held for over 4 decades, the behavior that follows is categorically different from a normal cyclical rally. Price does not drift gradually higher. It reprices violently, rapidly, to a level that reflects where it should have been trading all along if the suppression had not existed. He calls this lightning form repricing, and his technical indicators say we are in the early phase of exactly that process right now. Before going further, I want to address the dominant narrative that has been clouding the metals market for the last several weeks. The Iran conflict, the closure of the Strait of Hormuz, oil at over $110 per barrel. The fear that we are headed into the worst energy crisis in modern memory, and that precious metals should be spiking because of geopolitical fear. Oliver's response to this framing is blunt. War is not a fundamental for gold and silver. It never has been. He walked through the evidence directly. In March of 2022, when the Ukraine conflict began, gold was already above $2,000. The moment the war started, gold sold off all the way down to $1,613 by September of that same year. Oil went down, commodities broadly went down. Everything that conventional wisdom said should benefit from war did the opposite. The same pattern is playing out right now. When the current conflict escalated in early March, silver was trading in the mid-80s. It sold off, pulling back all the way to $61.20 on March 23rd, before immediately reversing. That is not how a broken market behaves. The real story, the one Oliver keeps returning to, is monetary. Go look at the M2 money supply chart from the Federal Reserve. Oliver points to it directly. The trajectory is nearly parabolic. The quantity of dollars in existence has been growing at roughly 80% per decade since the 1960s. A loaf of bread that cost 20 cents when Oliver was a child now sits at several dollars. A house that cost $4,500 for your grandfather cost $45,000 for your father. Today, the median home approaches $450,000. This is not real estate appreciation. This is monetary debasement expressed in housing costs. And silver, along with gold, is the thermometer that reads that debasement. Add to this the bond market situation Oliver describes as deeply troubling. Japan is in the middle of a bond crisis. The U.S. bond market, by Oliver's assessment, is sick. The Federal Reserve began purchasing bonds in November to artificially support yields, providing liquidity, as they framed it, while the reality is that the long end of the debt market is choking commercial real estate and consumer credit simultaneously. Meanwhile, the financial sector banks, brokers, credit card companies, insurance has broken long-term momentum structures that Oliver has been watching since October. 3 of the largest financial institutions have broken the kind of technical levels that his system flags as significant negatives. The stock market has not reflected this yet because headlines keep providing reasons for rallies. Tariffs became the narrative in early 2025. The war became the narrative. Now, Oliver expects the S&P to produce another rally, possibly back towards 6,800, before the underlying deterioration in the financial sector becomes impossible to ignore. But when that moment comes, central banks will do what they always do. They will print, they will provide liquidity, they will expand the money supply to try to save assets they want to support. And history shows with almost mechanical consistency that money created in panic does not go where central banks intend. It does not flow into stock markets when those markets are already broken. It flows into hard assets with genuine scarcity. It flows into gold. It flows into silver. Oliver puts it plainly. That is what is really going on. Not the war, not tariffs, not the headline cycle. The underlying reality is a global monetary system under structural strain, and precious metals are pricing that reality in. Let me explain the technical case for $300 to $500 silver in terms that remove all the abstraction. Oliver's momentum structural analysis does not look at price charts the way conventional technical analysts do. He is not drawing trend lines. He's not looking at overbought or oversold signals on a relative strength index. Those tools tell you how fast the car is going. What Oliver measures is the engine, the underlying force generating the movement. And his system has a track record of identifying specific patterns that appear before explosive, multi-year commodity moves. He points to copper, which traded in a compressed range for roughly 2 decades before breaking out in 2003. Once the structural momentum confirmed the breakout, copper went from below $1 to $4.50 by 2011, 7 times the entry price over 8 years. Investors who recognized the structural shift early captured the majority of that move. Lead spent 30 years oscillating around 50 cents per pound. In 2007, after confirming a structural breakout by Oliver's metrics, Lead ran to $1.75 in under 18 months, 3.5 times in compressed time. Oliver's system identified both of those breakouts before the mainstream recognized what was happening. Silver's current momentum readings are showing the same pattern, but with readings he describes as stronger than either copper or lead at comparable stages. The structural base that is built in silver is wider. The fundamental deficits supporting the price are more severe. The monetary tailwind is more powerful than anything present during those prior commodity breakouts. And here is the historical framework he applies to generate his targets. Gold has now completed 2 full bull market cycles since it was re-legalized in 1975. The first cycle ran from $260 at the 1976 low to $850 at the 1980 peak, roughly 8 times the low. The second cycle ran from $260 at the 2001 to 2002 low to $1,920 at the 2011 peak, again roughly 8 times the low. Apply that same multiple to the 2015 bear market low of $1,050, an 8-fold move targets $8,400 for gold. JP Morgan, in a separate analysis, put their fundamental target above $9,000. Now ask what happens to silver when gold reaches that level. During the 1979 to 1980 run, the gold-silver ratio compressed aggressively. When that compression occurs, when silver outperforms gold on a relative basis, the mathematics become extraordinary. With gold at $8,000 to $9,000, even a conservative ratio produces silver prices that are multiples of where it trades today. Oliver is not being creative. He's applying historical bull market dimensions to current structural conditions and letting the mathematics produce the output, $300 to $500 per ounce. And he adds something critical. It will stay there. This is not a spike-canned crash scenario in his view. This is a repricing to a new reality. The same pattern that copper demonstrated after its breakout. The same pattern lead demonstrated. Markets that undergo structural momentum breakouts do not snap back to their old ranges. They establish a new floor and build from there. Now, let me add the fundamental layer to what the technical structure is signaling, because the two stories are converging in a way that Oliver describes as rare. Silver has been running a structural supply deficit for years. Global consumption exceeds global mining output. That gap cannot be closed quickly, regardless of price incentives. Mining a new silver deposit from discovery to first production requires a decade or more of permitting, capital raising, and infrastructure construction. Existing mines are working through their best ore grades. Recycling supply helps, but cannot bridge a structural shortfall of this magnitude. On the demand side, Oliver points specifically to solar manufacturing. China produces 80 to 90% of the world's photovoltaic solar cells. That single application is consuming silver at a rate that grows alongside the global push toward electrification. It is not discretionary demand that softens during recessions. It is structural demand baked into energy policy across dozens of countries simultaneously. He raises an important nuance when discussing whether economic weakness from high oil prices would reduce industrial silver demand. His answer is no, and for a reason most people miss. When economic downturns arrive, central banks respond with emergency liquidity. That money does not go where the Fed wants it to go. It does not rescue the assets the central bank is trying to support. It flows into gold and silver. This is not theory. This is the documented behavior from multiple prior cycles. The late 1970s stagflation, the 2008 financial crisis response, the COVID-era monetary expansion. So industrial demand remains structurally supported. Monetary demand accelerates during economic stress, and supply cannot respond quickly. That is the fundamental setup. Oliver's description of silver entering a new reality is not a marketing phrase. It is his technical observation that the market's behavior has shifted character, that buyers who are absorbing price drops in days rather than months are not retail speculators. They are industrial users and institutional accumulators who view dips as procurement opportunities, not panic signals. When the dominant buyer is indifferent to short-term price volatility, the market's dynamics change permanently. Here's the part of Oliver's analysis that deserves its own section because he is not speaking abstractly about this. He stated directly in his own personal portfolio. He is heavily into the miners, with a specific focus on silver miners over gold miners. His reasoning is structural. He tracks a spread between silver mining ETFs and gold mining ETFs, dividing the silver miners into the gold miners and plotting the result over time. By his technical metrics, silver miners broke out relative to gold miners approximately 6 months ago. That relative breakout preceded the price-performance gap that has since appeared year-to-date. From December 31st through the end of March, silver is up approximately 7%. Gold is up slightly more than 7%. The gold mining ETF GDX is up above gold's performance, and still, the silver mining ETF is outperforming all three. This during a period when the S&P 500 is down 6 to 7%. Oliver believes this outperformance will accelerate, not revert, as silver's price makes its next leg higher. The leverage mathematics explain why. A silver mining company producing at a cost of, say, $20 per ounce is currently operating with a margin of approximately $1.52 per ounce at current silver prices. If silver reaches $300, and that same producer is operating at roughly $280 per ounce margin, the metal price did not quadruple the profit, more than quadrupled. And mining company valuations have historically expanded at multiples of profit expansion during commodity bull markets. In prior commodity booms, uranium in the early 2000s, lithium during its peak cycle junior, miners in the right position produced returns that made the underlying commodity price move look modest by comparison. Oliver's emphasis on the silver miner sector is not casual commentary. He describes it as the place where he personally is concentrating capital. For investors with the risk tolerance to handle interim volatility, and the volatility will be extreme and must be expected, the miner positioning is where the leverage exists. He also makes a broader point about commodity assets in general. The Bloomberg Commodity Index gave a momentum breakout signal in October of last year at a price of $16.50 per unit. It has since traded above 140. Its all-time high in 2008 was above 230, even after the recent move. The broad commodity complex is not expensive by historical standards. Base metals look constructive. Energy assets are in the early stages of what his signal suggests is a multi-year uptrend. Oliver's framing is that you can point at almost any part of the commodity complex and find a rational case. But silver is special. Silver is the one where he uses the word parabolic. Let me zoom out to the broader picture that frames everything Oliver is describing. Right now, capital is beginning to leave financial assets. Oliver has been watching the financial sector, the banks, the brokers, the insurance companies, the credit card businesses, for months. The relative performance of these institutions compared to the broader stock market is at multi-decade lows. Technical momentum structures within individual major banks have broken down. This is not yet reflected in the headline narrative. The public is watching tariff news, war news, Federal Reserve commentary. The underlying deterioration in financial sector momentum is not on the front page, but institutional money, the capital managed by people who read momentum structures and not headlines, has already started to move. Gold miners have been going nearly vertical in relative performance over the past year. Someone's moving money out of financial assets and into hard asset exposure. Oliver's argument is that you're watching early accumulation, not a completed move. When the stock market produces its next major downleg, and Oliver believes the high may already be in dough, he expects one more rally attempt, first toward 6,800. The response will be institutional panic. Central banks will expand balance sheets. Money supply will expand. And the public, who until that point had been told by financial media that silver already had its run, will suddenly look at a chart showing silver at $150 or $200 and start asking how to buy. That phase, the public recognition phase, is where the most parabolic price movement occurs. And by that point, the investors who positioned in the 70s will already be sitting on multiples of their entry price. Oliver is explicit about where we are in this sequence. We are in leg 2 of the advance. The base was built. The multi-decade ceiling was broken. The correction reinforced the structure. The acceleration phase is beginning. The mania phase, the one that produces the numbers that seem impossible today, has not arrived yet. This section matters as much as everything before it, so do not skip past it. Oliver is not telling you this will be comfortable. He is not describing a smooth, linear ascent from $72 to $500. He is describing a violent, volatile, psychologically demanding journey that will at multiple points feel like it is failing. Q1 was a preview. Silver struck $121.79 on January 29th, the highest price this metal has ever traded in modern market history. By January 30th, it had crashed to $74, even in a single session. It recovered into the 90s. Then the conflict-driven sell-off pushed it to $61.20. On March 23rd, nearly a 50% drawdown from the January peak, all within a single quarter. In the context of a bull market that ultimately reaches $300 to $500, a 50% correction from $121 is structural noise. The mental framework that Oliver operates with, and that any investor in this space must adopt, is consequence-based, not price-based. The question is not whether $72 feels expensive after the run from 40. The question is whether the structural case for triple-digit and potentially quadruple-digit silver has changed. His answer is that it has not. The war did not change it. The correction did not change it. The sentiment deterioration did not change it. Position sizing matters enormously in this context. This is not a market where concentration is rational unless your risk tolerance is exceptionally high. Physical silver coins, bars from reputable sources, provides direct ownership without counterparty exposure. Mining equities, particularly in the junior space, provide leverage to price performance, but also leverage to downside. A 50% drawdown in a junior miner is not exceptional during the volatile phases of a bull market. It is expected. The time frame Oliver works with is not daily or weekly. He is looking at a structure that develops across months and quarters. Investors who check prices daily and react emotionally to every swing will make decisions at the exact wrong times. The discipline required here is the willingness to maintain a position through discomfort when the underlying structure has not changed. Here is how Oliver frames the totality of what is happening. For 50 years, silver had a ceiling at $50. That ceiling is now broken and behind us. The technical momentum structure that identified this breakout is the same framework that captured copper's 7-year run lead's 18-month explosion and gold's to multi-decade bull cycles. The readings in silver right now are stronger than those precedents. Simultaneously, the monetary environment is more distorted than it has been in living memory. Central bank balance sheets are at levels that would have seemed impossible 30 years ago. Bond markets in both Japan and the United States are showing structural stress. The financial sector, the banks and brokers that intermediate the entire debt-based economy, is showing technical deterioration months before the headline narrative acknowledges it. The stock market, sustained by 16 years of artificially cheap money, is sitting on a foundation that Oliver describes in plain terms as a bubble. Gold itself struck $5,626.80 at its Q1 peak before pulling back to $4,124. A correction of over 27% before recovering to current levels near $4,683. Silver's behavior mirrored that pattern, but with more amplitude. Both markets absorbed extreme selling pressure and recovered. Both markets have structural momentum intact. That synchronization is not a coincidence. It is the same underlying monetary force driving both. When the stock market bubble corrects, whether the high is already in or arrives after one more rally, the central bank response will be the same response that has occurred in every prior monetary crisis. More liquidity, more money creation, more currency to base. Silver has been pricing that reality. Silver will continue pricing that reality. The supply deficit is structural and cannot be resolved at any price level in the short term. The industrial demand from solar, electrification, and advanced manufacturing is accelerating rather than stabilizing. The monetary argument is strengthening rather than weakening. Oliver's $300 to $500 target by end of 2026 is not a guess. It is the output of a technical system applied to current momentum readings, calibrated against historical bull market dimensions, supported by a fundamental backdrop that is, by every metric he describes, more powerful than any prior commodity supercycle he has analyzed across 5 decades. Monday, April 6, 2026. Silver at $72.13. Gold at $4,656. These are not the prices of a market that has finished moving. These are the prices of a market that Oliver's analysis suggests is in the early acceleration phase of a move that will redefine how investors think about precious metals for a generation. The decision in front of you is not whether to time a perfect entry, it is whether the evidence warrants attention. Study the deficit data, understand the monetary dynamics, review the historical precedent in commodity breakouts that Oliver's system has identified. Consider what his technical readings are saying about the financial sector deterioration that has not made the news yet. Then, based on your own research, your own risk tolerance, your own financial situation, Decide whether silver and the assets that leverage silver's performance deserve a position in how you're thinking about the next 12 months. Oliver's timeline is this year. His minimum target is $300. His upside projection is $500 from $72. The window between now and when the broader public recognizes what is happening is the window that matters. Choose what to do with it thoughtfully. Nothing in this video constitutes financial advice. All prices cited are as of Monday, April 6, 2026, at approximately 2:25 a.m. Eastern Standard Time. Always conduct your own research and consult qualified professionals before making investment decisions.